Welcome to the Broken Pie Chart Podcast, episode 342. I'm your host, Derek Moore. With me on the program today is Mike Snyder from Zega and Shane Skinner from Zega. We're going to try the three-man booth today. They say not to do this, but Monday Night Football tried it. I don't know if you guys are too young to remember when Dennis Miller was actually in the booth at Monday Night Football. Do you guys remember that?
I don't remember that.
I can't say I remember that either.
All right, moving on then. Let's talk about the Fed. So next week we have a Fed meeting, and all eyes or all the talking heads are saying it's going to be 25 basis points. Mike, any reason to think they're going to do otherwise?
No, I don't think so. I think this has been pretty clearly forecasted and implied that they're going to do that. I've seen some people saying that they think that they should do a 50 basis point cut. I mean, that's just what they want them to do. I don't think the Fed has indicated that that's really what's going to happen. I think it would be a shock if they did nothing. So I anticipate that that's exactly what's going to happen, is that quarter point.
I mean, that's what the market is saying. Shane, does it matter though? I mean, does it even matter if the Fed cuts a quarter point or a half point? I'm not. Well, let me hear what you say.
I think it matters more if the Fed doesn't cut versus if it cuts a quarter versus a half, if that makes sense. I think if the Fed doesn't cut, that really throws people off. I think if you cut 50, we might see a more euphoric market, sort of happy to see 50. If you see 25, I would think business as usual and maybe some profit taking. We'll see.
All right, so we look at the Fed funds futures curve, September 25 through 27, and Charlie Bolello put this out on Twitter, and we've got the chart here. And basically, by the end of 2025, the Fed funds futures expectations, and Fed funds futures, you take 100 minus the price of the futures contract in that month, and that's the implied rate, kind of the quick back of the napkin. 3.63 by the end of 25. And that would imply what? It would imply about 50 basis points. So a quarter here. I don't think it's quite 25% or 25 basis point cuts. And then, I mean, the Fed funds futures, and look, I don't know who's trading these out in December of 2026, but 2.86. So you look at the Fed funds futures curve, and you would say that it is telling us, or it is saying the probability is that between now and the end of 26, Mike, what is that? Is that that's 1 point would be, it's like 150 basis points of cuts, right?
Right. Yeah.
I mean, do you think that's too rosy?
I mean, it's what the market's pricing in. To me, it seems a little rosy. But that's what the market's pricing in.
I mean, here's the thing, too. To get to 2.86, that implies either inflation is going to really continue to drop, or there's some problem in the markets. Like, Shane, we've talked about this a couple weeks ago. Be careful what you wish for. Like, if you think interest rates are going to go much, much lower, doesn't that imply, Shane, that there's some upset in the market and the Fed is coming in to do a quote unquote rescue, right?
Absolutely. I mean, I think at one point I didn't even know this was possible, right? Until I'm going through finance school, come out and start my career in the early 2020s. But, some people calling for negative interest rates at one point a couple of years back, right? And it's kind of insane to think that any logical system would think that near 0% interest rates is healthy or good. I don't think the curve is off necessarily, because I think what's going to happen is in February, I think you're going to have someone appointed to Fed chair that's very dovish, very open at cutting. And so where I think the curve here might be off, who knows, is maybe it's overestimating how much Powell's going to cut before he leaves. But at the same time, it just seems by sort of a combination of, the forces that be, that influence this stuff. I just think that you're going to have someone very dovish come in. I also think that if you look at the jobs market right now, that revision from 2024 was not great. And it's sort of weird to think that, wow, we went through 2024 thinking this about jobs data and the market, only to find out in September of 2025, oh, no, actually, this is what went on with jobs in 2024. And so, I think it's one of those, I'm going to say it, like, if we were in a recession and didn't know it, it's one of those where now if we kind of all of a sudden, okay, hey, we need to cut, we acknowledge it. I don't know. The jobs market's tough right now. I'm hoping to see more hiring in September.
Is it tough though? Is it?
I'm talking to a lot of younger people, and I'm seeing a lot of college grads are having a really hard time right now finding work. But maybe that's because of the specific area they're in, the school, whatever it is, demographic, geography. I don't know.
If I look at all employees, total non-farm payroll, and this is from the Federal Reserve Bank of St. Louis, also called FRED. If you don't know what FRED is, Google it. You can find data. And basically the revisions that happen, I think it was, so what are we in August? What was before? July. So I think was it
July.
June?
June.
Was it June? Was a negative 13,000 revised. And that was actually the lowest. That was the first negative going back to January of 2021. So the idea is that employment is softening. And I would say, is it softening? I think the chart shows that. The revisions aren't surprising, though, because what you have is not predictions, but you use surveys. You ask people the questions. You use a sample size. And then you actually get state data. And the state data tells us what the jobs number is revised. But there are multiple revisions. So I don't know. Mike, I think the other thing, and we touched on this, was it last week or the week before, that would a rate cut actually help housing? And I'm not sure. I believe that if you have rates that are lower, it definitely helps buyers. The question is, do home prices go up relative to what people can afford? But Mike, as someone who has done this recently, like, are you going to refinance if they cut next week a quarter point?
I wish that it would help me, but I don't think it would. I think rates are going to have to come down more than just a quarter point for refinancing to make sense for me. And I think they're going to have to come down a lot more than a quarter of a point for it to make sense for a lot of people who already have mortgages. And so rates coming down, for first-time home buyers, it might be a good opportunity for those people to come into the market and say, okay, I'm going to take advantage of rates coming down, but I don't see a lot of refinancing happening. I also don't see a lot of, I think a lot of people have lower rates than what's available and are sort of stuck in those or not wanting to give up those and probably aren't going to look to sell their house and buy a new one just for that reason.
If there's some data, this is from Goldman Sachs Global Research and EMBS. I actually don't know who EMBS is. I'll look that up. 85% of outstanding mortgages have interest rates below the PMMS, distribution of outstanding 30-year conventional mortgage borrow rates. So basically what you look at is if you say, okay, who has lower than even 6%? It's most people. And I didn't count this up, but I'm eyeballing this 3, 6, 9, 10, 11, 12, 30. What is it, like 15 to 20%?
Lower than 4. Lower than 4% is a good chunk of people, right?
Well, yeah. Actually the mode, so that's like what shows up the most.
Yep.
It's 12% is probably between 275 and 3 right there. And I think the point is, and really where you're going with this, Shane, is that although you could get a rate cut, it may not cause a refinancing boom because people are locked in.
Right.
But Mike, to Mike's point, look, I think housing is a little bit locked up, and people who are selling don't have the reality that people who are buying have a higher interest rate. But I would agree. I mean, I don't think this just sets off a refinancing boom. And
I also don't think this causes home prices to collapse either. And I would think both of you agree, as someone who's in the process of doing this as well right now. Looking at this, I'm sort of getting into a home with the expectation right now that I'm not counting on mortgage loans to go down in the long term here in the next 3 to 5 years. If they do, 3 to 5 years from now, I'm ready for that refinance. I'm sure, Mike, you are too. But my concern is actually upside to 30-year mortgage interest rates than downside. And looking at it now, it seems like you're better to maybe get in now. And if you get the drop, great. And if you don't, 7% is a lot better than if this were to continue higher for any reason.
all right, so here's what I'll take a contrarian take. And Mike, you can let me know what you think in a second. But look, I mean, the Fed had near zero rates 2009, 2008 period through probably 2020. Well, 2018, they finally raised it. And there was no inflation. And look, I mean, housing did okay. Mike, I mean, just because the Fed lowers interest rates, do you agree with me that it's not necessarily going to cause inflation?
No, I don't necessarily think so. I don't. Yeah, I kind of agree with Shane here. I think that housing is. I think it's in a period where it's going to be pretty stable. I don't see a ton of upside in the near term, given how much it's run here recently. But I also don't see a ton of downside because I just don't think that there's going to be so many sellers because people are stuck with their current rates and their current homes.
One of the things, it's funny. I was talking to somebody who's a real estate agent, and they said this market's really bad. I said, bad for who? Home prices have not been gaining. They have not necessarily been falling. And then what they said was, well, look at all the price reductions. And I said, what you're doing, though, is you're looking at either transactions or listings. And to make a market, you have to have a buyer and a seller.
Thank you.
But housing has not collapsed. It has not collapsed. It hasn't. And I know you can watch YouTube, and there's 30,000 videos that seem really compelling. They make a lot of good points. And by the way, I didn't watch all those videos. Somebody else can do that for me. But anyway, getting back to rates, I think it will be helpful. But what people continue to miss is it's the spread between the 10-year Treasury and the 30-year mortgage rate. It's historically, based on the data that I looked at, about 170 basis points, meaning if the 10-year Treasury is 4, add 1.7% to it, and historical average would say the mortgages should be 5.7. If that just compressed, forget about the Fed doing anything. And by the way, the Fed deals with the short end, and sure, it has some effect on the long end, but that's more of the market. If it just compressed, that would be a huge deal, and you would unlock a little bit more activity there. So, all right, let me go to gold. And apparently gold set a new inflation-adjusted peak as bull run continues. So spot gold price just hit an all-time high, but then you use the inflation adjustment. And the inflation adjustment in gold actually finally eclipsed the inflation-adjusted price from 1980. So, Mike, I don't know, is this anything? Like, does this matter? You tell me.
Yeah, I think it matters.
How so?
I mean, I'm wondering at the end of the day, what it means and why people are buying gold. Is this a safe haven trade? People are worried about currency risk. Is this an inflation hedge? Is this speculation? That's what I'm most curious about.
Hedging against the U.S. dollar, central banks. We talked about it in our last. We talked about it in our last podcast, right? Central banks are buying.
I mean, Shane,
and the question is, does it continue? That's That's what we
Well,
were.
I mean, if you look at what central banks are doing, I agree. I mean, we've looked at the data, we looked at the charts. They're definitely buying gold, which is interesting. But to Mike's point, is it an inflation hedge? Like, Mike, do you think people are buying this because they think inflation is going to go up and therefore I want to own gold? Do you think that's really the compelling reason?
Right now, like new buyers into gold, no.
Yeah.
My gut says no. I think people who have owned it for 20 years, that's why they own it as an inflation hedge, and they just strongly believe in using gold as an inflation hedge. I think there's a lot of speculation. I think there's missing out on returns, and people are looking at it again saying, would it hurt to have 5% of my portfolio in gold? It's sort of been forgotten, I feel like, over the last few years with Bitcoin, is sort of this alternative gold that people want to own. And maybe we're seeing a similar effect in gold now.
It's the other thing is non-correlation. So I did some analysis, as you both know, for a strategy that we are incubating at Zega. We're always incubating, trying new strategies, and deals with stacking assets on top of one another. We'll have more to say about this soon, but you look at since July, starting in July of 2007, and there's a reason why I looked at this data, because if you owned assets coming into 2008, you sort of, did I cherry pick my analysis time? Absolutely, because I wanted to go through some of the worst periods. But you look at the correlation in gold. If you take gold, or let's just say the S&P 500, there is a correlation of something like, let me go to my monthly returns.
I'm thinking 0.6 is what my head goes to. I could be way
Okay,
off.
so the S&P is to gold 0.07664.
7664.
You said 6, right? You mean 6%.
6%. Yeah.
Yep. And so you look at that, and gold has typically, over the long run, had some non-correlation. By the way, to something like 5-year treasuries, if you're interested, and maybe you are, but I'm going to say it anyway, gold is about about 32.5% correlation since June of 2007 to gold. So I don't know. I mean, I think some of the non-correlation, like that's one of the things that people are after when they put a bunch of stuff in a portfolio and they hope it goes up or down at different times. So, but yeah, I mean, Shane, the other thing to look at here is, and this was a chart from Eric Baltunis at, where was this? Oh, the gold inflation one, that was from Bloomberg too. So this is probably from Eric Baltunis as well. And he points out that since 2015, GLD, cumulative return, up 216.17%. GDX, which I think is the gold, that's the VanEck Gold Mines ETF, it's up 481%, meaning the gold miners are up more than the commodity itself. So, Shane, is this like, some people are like, oh, I want to own the miners. Other people are like, I just want to own the thing, because if they don't run a good company, then I still can do okay based upon. But does this tell us anything, Shane?
Yeah, I mean, I think it speaks to. I think that actually, and you know what, Mike has way more experience in this business than I do, so I might.
Right, let's go to Mike then.
I'll say this. I think that as a default, the market has almost gotten a little bit lazy in its. I want exposure to gold. Well, you know what I'm going to go do? I'm just going to go buy some miners, right? Like I might go buy gold miners, not just gold, but gold miners as well. And so I think that the market has this sort of, you know what, if I'm buying gold miners, I might as well be buying gold. I think some people treat it the same psychologically. I'm not saying they are. I also think that the idea too is maybe there's a little added risk there, right? In the sense that if gold does well, a good gold mining company should be doing well, right? And maybe there's more potential for payoff risk reward wise in a gold mining company than gold itself. However, I also think that they're sort of reflexive and sort of there's a relationship right there, right? Like if gold's doing good, miners should be doing good. And if miners are doing good, well, it's probably because gold's doing good. So it seems a little symbiotic, but I will ask Mike, because Mike's had probably a decade longer in this business than I have in terms of working with clients and seeing what they like. Like, have you seen clients, Mike, that are more like open to, hey, gold exposure equates to just owning some gold miners or owning a little gold and a little gold miner? What's your take on that?
Yeah, in the early 2010s, I would say I remember a lot of interest in miners, a lot more at least than I hear now. I mean, it's essentially a leverage play in my mind on gold, right? Like these companies have a fixed cost to mine gold, and gold goes up, 1%. That might be a 3% profit or margin benefit to these gold miners. So in my mind, it's sort of a leverage play on gold. I think, the majority of people who want to own gold for the traditional, I would say older school reasons, like as an inflation hedge, are just going to continue to own gold, whether that be GLD or in physical form. But
do you think people might be buying miners and shorting gold as a sort of pairs trade then at that point?
We could.
It's possible, but here's another little take on this. Think about gold companies. So if you own gold, you basically own the price of gold. But if you own gold miners, in theory, they are selling gold. They're almost doing a reverse dollar cost averaging. They're selling gold and unloading it when prices are high. I mean, they're unloading it all the time, but it's almost like a selling as a dollar cost averaging. And maybe over time...
Interesting, like inverted, right.
Yeah, I mean, they take advantage of that. I go, to what Mike is saying, though. Yeah, I mean, you do have a little bit of leverage there. If their fixed costs are fixed and they are the supplier, de facto supplier, then yeah, I mean, it's... But Mike, I mean, I go back to something you said too, and it's... I think this is still a stealth rally. I know for us, like we know gold's made new highs. We know it just made a new inflation adjusted high. But Mike, I mean, people are not talking about this, or they haven't been. And it's been 2.5 years that gold has been going higher.
Yeah. I get asked about Bitcoin way more than I get asked about gold. I actually don't ever get asked about gold with either friends that I'm talking to, even that are in the business, and we're just talking about markets. No one talks about gold. Clients, I don't get asked about gold anymore. I used to get asked about it all the time, and I can't remember the last time someone called and asked what I thought about gold. So I think that has something to do with it.
All right, let's go to bonds. This is from Fidelity, and I'll explain what the bond PE is. The bond PE is you take 1 divided by the yield. So right now the 10-year treasury is 4.06%. 1 divided by 0.0406 is 24.63. Fidelity put out a chart of the historical, since 1994, bond PE. And no surprise, in 2020, I mean, it was like, they have that print at 318. I don't know when that was. That was probably when rates went negative on the short end. But around 160. So the lower the yield, the higher the PE. And they've also got a chart showing is this the flows? Yeah, these are the flows. So the year-over-year change in end investor flows, that's the pink one. The audience can't see that, but for you guys. And then you're looking at some of those. So what's interesting is you see that the flows dropped. And when the flows dropped, that was the low in the flows corresponded to the lowest PE, meaning 1 divided by the rate. And so the higher the rate, the lower the PE is. And they're asking, is this a continuation pattern? So what the heck am I talking about? it's kind of just saying that there are flows back into bonds. And when people are buying, the marginal buyer comes in, they're pushing the price of the bond up, the yields go down. Shane, is this, I know everyone thinks that 10-year treasuries and the longer dated treasuries are going to go up because of the debt and because of the tariffs and all this. No, it hasn't happened.
No,
They're going lower.
Because the Fed's going to buy it. I mean, let's be real. If you look at the securities held outright, U.S. Treasury securities on Fred, it's starting. We in 2022 peaked, and over 2023, 2024, 2025, this is curved down and sort of flattened. It's going to go back up again. Historically, when it's flattened, it might stay flat for a year or two, so it might be a little bit, but at some point, I mean, if there is a liquidity issue, whether it's the front end or the back end, I think that the Fed is going to step in and do what's needed to be done to, ensure stability. I also, looking at this chart, we're trading at a level on the buyers and sellers of U.S. bonds chart that you provided from Fidelity. We're trading at a level that we hadn't been at since I was born. So that
you're 13, so that's not surprising.
Okay, well, listen, it's still. I mean, come on, that's monumental for the fact that we're trading at levels that technically the last time we were here was about 2008. We were this low on this. It seems like it's basing to me. I mean, I could be way wrong, right? We'll see in 3 years, but it looks like it's basing. So we'll see.
We had a historical bull run in bonds, meaning bonds go up, yields go down, from 1982 to probably 2021. I mean, that was really when, we started to see yields, certainly into 2022 for sure. And the question is, for that to happen again, yields would have to go negative. I'm not sure that yields are going to go back to zero.
I don't see it.
No, I don't necessarily think that. Quite honestly, I don't like the fact when yields were negative. Like, people should get something for putting their money into a bond. But could we trade sideways for a while? Like, just because, I mean, it's one of the misunderstood things by a lot of investors when they look at backtest, and they look at backtest with bonds in a portfolio. Of course, bonds did unbelievable. The yield was, you could have bought a 30-year treasury for what, like 17% back in 1982. So, yeah, I mean, it does seem like we're basing a bit here. I don't know, Mike, when you look at this, I mean, it's pretty clear, as you know, as a trader, more buyers than sellers. And we had more sellers, we had outflows in bonds. Now that's turned. If we look at it as a chart, there's more buyers coming in. Like, this sort of makes sense why yields are going down, right?
Yeah. It's interesting that it's the end investor on the chart that's making up a lot of, I guess, a lot of the buying that is being reduced by the Fed. But yeah, I mean, right now there's more buyers than sellers, and Shane mentioned that it's historic. It hasn't been at this level, since the early 2000s. But if you look over history, it's actually, pretty average where it's at. So
it's very average. Yeah, I mean, I go back to, as the oldest person on the call, I can talk about investing in being in the markets in the 1990s. Yeah, I mean, we had 4.5%, 5% interest rates, Fed funds around that, and the markets were fine back then too. I mean, as we kind of tie this to equities. So, look, I mean, the Fed's going to come out next week. They're going to say stuff. I think it would be a shock if they didn't cut a quarter point, just because this Fed has very much telegraphed every move that they've made.
By the book.
Yep. By the book. They've messaged it. So it would be surprising. The question is, and look, we don't know what's going to happen. That's why we buy and hedge. We buy and buffer. If you want more info on that, shoot me an email, derek.moore@zegainvestments.com. That's DEREK.MOORE at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments, you got to spell that correctly on your own. Otherwise, you're not going to reach me. So, I mean, look, this is why we hedge. But if we get the conditions, I'll go Shane to you first. If we get the conditions of an easing Fed, and then we have earnings going up, valuations are high. We know that. They're on the higher end. What's high? I don't know. I'll let you know in 6 months. But Shane, like if we get an easing Fed, if we get a Fed who's, let's say, does lower rates according to that curve we talked about earlier, it's either stocks will do really well or stocks are not doing well because there's some problem and that's why rates got there. I don't know. You tell me. Are we going to 7,000 in the next 6 months, or are we going to what's equidistance down lower?
I think the pain trade for the next into the end of the year would be sideways. I think the one that would really get people is if we don't quite go to 7,000, right? But we don't maybe break below 6,000. At the end of the day, with the way everything's staged, I've told you before, I think this is more looking from a technical perspective, like 1995, 96, like we're on the process of breaking out to the upside here. Yeah, I mean, I think a Fed cut here, I think it's bullish for crypto. I think it's bullish for the index. I don't see what fundamentally, it'd be barring some insane geopolitical event that isn't being priced in, the black swan, right? I think this market's path of least resistance is higher.
All right. But of course we hedge. We have no idea. So Mike,
don't ask me where we're going. You don't want to know where I think we're going.
Mike, I don't know if you want to take the bear case. Like, is it employment? Is it employment? And that's the reason why the Fed cuts have to happen. And it kind of rains in everybody's parade. Because we know that when people en masse start to not be able to get jobs or they lose their jobs, like the aggregate demand drops in the economy. Like, is that the bear case here? Or do you have another bear case?
Yeah, I think that could be a bear case. Like you said, if rates are dropping, it doesn't, us forecasting rates dropping might be good for equities in the short term. It doesn't necessarily mean that, at some point, the focus has to go on what's actually going on with the economy, right? Once rates have been cut, like, okay, is the economy doing well? The economy is not doing well, and you have to continue to cut rates to soften that. Eventually that becomes an issue. There's only so much room you have to cut. So I would say at some point, right now, I think, we're sort of in a cycle where some good news can be perceived, or some bad news can be perceived as good news for equities. At a certain point, I think bad news can become bad news again. It's just a matter of when.
All right, so let's talk about the University of Michigan, who I don't like talking about, but I'll talk about it anyway. 1 year inflation expectations come out, so they survey people. Who are they surveying? I don't know how they get these people, but people identify as Republican, Independent, or Democrat. And the audience can't see the picture, but every group is their inflation expectations 1 year out are coming lower. So even it doesn't really matter the affiliation. Republicans 1 year forward says plus 1.2% inflation. We're at what, 2.8 right now, 2.9. So Democrats are 5.6, Independents are 4.7. I don't know. I don't even know if I want to talk about this. It seems like the tariffs are now in the rear view. Like tariffs, I don't think were as bad as even the people who thought they would be really bad were. Shane, I mean,
after PPI and CPI this week, absolutely. I think that has cooled fears. I also think that a lot of people really missed Powell saying that they're okay with sort of straying from the 2% anchor. I think it's now 3%. And I have to give credit to a very good friend of mine. Like a year or two ago, he looked at me and he was like, they're eventually just going to say 3%'s okay, and we're just going to play in 3% land from then on. And at this point, I think we're right. I think 3% inflation will become the new norm. I think we're going to be okay with that. And at the end of the day, like, it's not the end of the world, but also I don't think we're going to see anything major deflationary on our hands either here, like we talked about with housing earlier. So, this idea that inflation's finally sort of tamed down and calmed down, I think that's correct. Again, barring some black swan event, everything's cooled off.
On the 2% target, that has only been around since 2012. I don't remember when in 2012. And that was Bernanke. And that's really, when it started. It hasn't been around that long. So the fact that they could change it to 3 or move it or take it off, I don't think it's as big of a deal as people think. Like, there was no target.
Right. And did they even actually track it very well? Like, that's the other thing. It's just a buzzword. It's a talking point. At the end of the day, I don't think we actually tracked 2% on the dot exactly as they had said they wanted to.
I don't have it handy, Shane, but I did do the analysis to see what percent of the time we were within from 175 to 2.25, and it wasn't that much. It really wasn't. We're not really there that often. We're kind of below it. I mean, we were below it a bunch, and since in the 10 years since the GFC, but yeah, I mean, so, and it's arbitrary anyway. Why 2%? Why is it? And
I don't know. Why is the sky blue, Derek?
Well, they talked. I'm Googling it right now. This is the Federal Reserve Bank of Richmond. The origins of the 2% inflation target. Established in 2012, but the internal debate began decades earlier. Okay, there you go. So I don't know, Mike. Any comments on this University of Michigan? I also think too that, Mike, we were talking about this. We had an advisor, a client of an advisor recently say, "Hey, this market's not great right now, so I think I don't know if I want to stay invested." And I was like, "Not great. We're at all-time highs. Like, why would you say it's not good? I mean, are you saying it's going to go down? But to say it's not great, like, we're kind of up a lot." So I don't know, Mike. I don't know if you're a fan of these surveys or not.
Not really. I mean, it's the world we live in right now, and when you're investing, you have to. It's hard, but sometimes you have to try to look at the data and put your personal bias aside. And the data has shown there's no doubt about it. We're in a great market. So
I'm looking for it. Okay, this is from Investing Live, and the headline is, so I'm not going to read this. I'm just going to read the headline. Without any context, ex-Goldman Sachs CEO Lloyd Blankfein warns of looming crisis, but stays 100% in on equities. So, okay, that's...
Depart you from your equities so someone else can buy it. Fear-mongering.
I mean, that's the thing. In the end, it's... You actually see the buyers and sellers, and people vote with the buy or the sell button or the hold button. I mean, hold is a choice too, but yeah, I mean, I don't know I know people are warning about it, and it's very easy. So here's my problem when people go on CNBC and they're like, well, if we get this, we get this, or if we get this, we could go down. Like, they're just couching it. Just give an opinion. Give an opinion, take a side, and put your actual money into it. So, I don't know.
Maybe we can get someone in that space on here one day to talk about that stuff. Give us more insight. We'll see.
I don't know. Mike, what were you going to say?
I was just going to say, just tell us what you're doing. If you think the market is going to go down if this happens, but you're not reacting or making any adjustments on your end to your portfolio in that way, then you're just saying words, right? What are you doing? Right? Because that's what you truly believe is, like you said, the vote comes with your money.
Yeah, where's your money at?
All right, let's talk about the VIX. VIX closed today 14.76. That is not the lowest close of the year. The lowest close was 14.22. I mean, we had the VIX hit on a close basis 52.33. It was over 60 in April of this year. It has been coming down, which it normally tends to do. There's not everything reverts to the mean, but VIX tends to revert to the mean. So, I mean, we're 14.76. Like the VIX is not necessarily saying that the market is pricing in a huge move. So, Mike, I mean, you and I have talked about this. The VIX being low doesn't necessarily mean it has to go up. Like the VIX sometimes when it's low, it can stay low for a while.
Yeah. And when you think, a lot of what we do is related to options and, generating option premium. And, a lot of times I hear, people looking at a chart of the VIX and saying, look how low the VIX is. I don't want to sell premium here. Well, it could stay here a while and you're missing out on opportunity. And it's also all relative, right? Like you're getting paid for the risk that you're taking at the time, which is what is being priced into the market. So yeah, the VIX is low, but it doesn't mean it has to go up. Eventually, is it going to go up? Yeah, but that might not be for weeks or months until it gets, back to higher levels.
Shane, I mean, it's some of our research, Zega meaning, and we have a strategy called the 4 Seasons that looks at 19 different volatility-based triggers, and then we score them, we rate it. It gives us sort of one of 4 market postures. But I remember telling you, Shane, that, in my analysis and our analysis that we did, yeah, I mean, there was no really correlation between a low VIX in itself and the market then taking a drop. Looking at different volatility points, though, together, or the way that we calculate them, it does give you clues. But yeah, like Shane, again, you're 12, but I don't know if you remember in 2017 that the VIX hit under 10. You were in the markets at that point, right?
I was dabbling, yes. I remember then the super low VIX. I remember XIV imploding the following year, right? February 2018, Volkswagen.
Yeah.
That was a fun one. That's actually the one that got me really intrigued into options and derivatives and this whole sort of what is vol space, because something that had the ability to have that great of an impact on the overall broader market is something to pay attention to, right? And so taking it back into what you were saying earlier, I feel like the VIX is so well known and simultaneously so misunderstood. I think people just obviously assume VIX up, market down, VIX down, market up. But it really gets into the whole term structure of volatility, right? And the idea that when you're pricing anything on a time frame or a timeline, different time periods involve different pricing. It's the same reason why your insurance on a car is a different rate at 6 months versus 12 versus 24 months, right? And so, at the end of the day, you look at vol of vol, right? It is one of those things, right? I think that's somewhere in there, right? The vol of vol. Yeah, but you realistically, you can't just look at one single point of a volatility measurement and just be able to determine what's going to happen direction wise because of that. It's like you said, it's a combination, and it shouldn't be misconstrued or just assumed that vol up, market down, vol down, market up.
All right, let me switch to Oracle. Oracle this week closed at like 240 and then went up 40% to a high of around 345. And it's since come back down. And, there's a saying, all gaps get filled. I'll let you know when I know whether it fills the whole gap. But that's an example of where the implied volatility, the move that was expected, it under expected the actual move. But what was interesting to us is the three of us were on our trading call, and we were saying, I wonder if a stock that's in the top 25 of the S&P 500 has ever moved up 40% or higher in one day. And for this, I sent a note to Mark Pulowski over at State Street. I posed the question to him. And his answer was, and I think he talked to his equity research team, didn't have, an example of maybe a top 25. NVIDIA, I believe it was last year or the year before, was up something like 23% in one day, not 40. GameStop was not part of, wasn't in the top 25 of the S&P 500, but certainly that stock.
It's not top of talk about GameStop.
Yeah. But the one that comes to mind, and I was glad he reminded us of it, is Volkswagen. So Volkswagen in 2008 was the 15th largest company from a market cap perspective. What isn't part of the S&P because it's a foreign company. But the stock underwent a short squeeze, which saw a 400% increase in 2 days. And it went from number 15 to the number one market cap weighted company in the world after that move. And from memory, it was, I think, Porsche, I forget how you say it. Porsche, I think, disclosed they either were buying some shares in them, and then there was a short squeeze. But that's kind of the example. And that went up way more than Oracle. And Oracle, I think when I looked, it maybe had a chance of being in the top, being number 10. When we looked the other day, I think it was number 12. It's probably back down now. But anyway, thanks to Mark and our friends over at State Street for taking a look at that, because would have taken quite a bit to do that research. So I don't know, nothing really else on that. I just thought it was an interesting point to bring up. So, Mike, any comments on that? You can say no.
No.
Okay.
It's interesting. And we were talking, and I kind of thought that might be the case, that there weren't any other, it takes a lot for a stock with that type of market cap to move that much. So I was kind of thinking that might be the answer.
Yeah, I mean, to put that in perspective, so what is NVIDIA? NVIDIA is over $4 trillion, right? So to move 40% would be, what, $1.7 trillion in added market cap if NVIDIA was to do it. That's sort of the scale of how that happens. So, all right. Let's go to recommendations. By the way, I ran into, I was at Future Proof. Good event. They do a great job. First time I ever went. Kudos to them. They do a really good job. It was outside in California. A lot of advisors there, a lot of industry people. But I did run into Barry Ritholtz, and I told him that I totally took his end to the Masters in Business podcast, where he asked the guest, like, what are you reading, watching, or writing, or I forget how he actually says it. So I had a short conversation with Barry about that. But I'll turn it to Shane, you first. Now, last week you gave us 17 books. Let's keep it to one thing that you want to recommend to the audience.
I'm going to have to, I don't know, man. NFL's back on. I'm gonna default to NFL. I've been very busy this week. Haven't had much time. Kid's been a handful. So you got a phenomenal game rematch of the Super Bowl championship, Chiefs and Eagles. Some of the best football you could ever see. I should say American football to our foreign listeners. I know it's not real football. That's soccer. But yeah, Chiefs Eagles on soon. So that's the game to watch.
Are the Chiefs, are they going to go 0-2?
I think so. I don't think the Chiefs will make it out of the second round of the playoffs this year, and you can timestamp this and hold me to it. I'm not saying make a market on it, but I don't think the Chiefs. I think the Chiefs runs over.
I got to be honest. When I was looking for the Chargers Chiefs game, that was what a Friday night, I think, in Brazil. Yeah, that was Friday.
Yep.
And I turned on channel. Well, I turn on NBC, it's not there. I'm like looking all over the place. So then I have to Google like what channel is it on? It's on YouTube. And I'm like, okay. At some point, when you make me search for the game, that's not great. I'm just going to say the quality was fantastic.
I miss TiVo and Dish. I miss it. I wish we'd go back to it, but
well, look, I mean, the quality was fantastic. Like the picture was really good watching the game on YouTube. The stream was fine. It didn't lag or anything. Sound was great. So good job by them. But I don't know. I got to now figure out where these games are. Mike, anything from you?
I'm going to go pretty off script here and recommend a grill. So just moved a couple months ago, have some more space. Always wanted to get a nice grill. I got a Weber Searwood. It's a smoker / grill. If you want to be smoking, different things, but you don't have the time to sit there and, play with the fire and mess with the wood, a Weber Searwood is perfect. You just load it up, set the temperature. There's meat thermometers attached to it. You just let it do its thing, and then it's done. So that's what I've been doing a lot of the last few weeks.
Well, I give you credit. Mike Puck once recommended his local air conditioning repair company. I'm sure our listeners in Belgium appreciate that. But yeah, no, I Googled it here. It's just the Weber Searwood 600. Okay. All right. Yeah, you can that can be a recommendation this week. That's good. Yeah, because if anyone who hasn't done, when I say barbecuing, it's not just using the grill, it's where you're burning the wood or the pellets and you're smoking instead of just, cooking on a grill. Yeah, I mean, it takes forever. And if you don't have an electric, it looks like this is electric, right?
Yep. Just load pellets in there. Yep.
So, all right. So I see that. All right, there you go. I'll send Weber the bill for the free spot there. I am going to hold off on giving my recommendation next week. I'm rereading a book because we may have a guest next week on the program, and it'll make sense next week. But looking forward to that. And you know what? I'm going to recommend Future Proof for advisors. It's a really, really good event. And what I love about it was outdoors. Usually you go to a conference and it's indoors and you're inside for a couple days. So it was good to see a lot of our clients who are advisors and people who are also interested in using us as an asset manager. And then also seeing some of our colleagues. So Rick Rosenthal from the SIBO. SIBO's always been a good partner of ours. And, if we've asked them for help in seeing if they can get contracts listed or other things. So anyway, good to see a few of the people there, and it was a good event. So thanks to I think Matt Middleton runs Future Proof. So good job, Matt. All right, I think that's it. We did it. We got to the end. So quarter point next week. We're all a quarter point, right?
Quarter point.
All right. Watch them do a half point. All right. That's it, folks. Send me emails, derek.moore@zegainvestment.com. If you want to know if you're an advisor, you want to know how to use our strategies, send me an email or just send questions. We'll read them on the air. We haven't done that in a while. In fact, I am kind of behind on bringing those up because people have sent in questions, but maybe I'll do that in 2 weeks. As I said, next week, we're going to have plan is to have a guest. And I think everyone's going to enjoy that. So, all right. We'll talk to you soon. Thanks for listening. See you, everyone.